Did you know you can buy a property, even an unmortgageable one, without using a traditional mortgage? Bridging finance is seriously a powerful tool if you understand how to use it properly. And in this video, I'll explain exactly how it works using real examples and how it can help you scale your portfolio faster and smarter. Hi, I'm Dan, a senior qualified mortgage and protection advisor who works with UK landlords, property investors, and developers to grow their portfolios using smart finance strategies. Bridging loans are one of those tools that just gets a bad reputation, mostly because people don't understand them, or worse, they use them without a proper exit plan. So let me clear that up. So what exactly is bridging finance? It's a short-term loan, typically secured against a property or multiple properties. You'll usually borrow over about 16 to 18 months, and it will be interest only, with many lenders allowing you to roll the interest up and repay at the end. The key thing is to understand that bridging loans aren't cheap, and they're not a long-term solution. They're about speed, flexibility, and unlocking opportunities that traditional mortgages cannot support. So let's talk real numbers for a minute. Most reputable bridging lenders will lend up to 65 to 70% of the property's value. So if you're buying a property at 300,000, you might be able to borrow 195,000 to 210,000, depending on the lender and the deal. That means you'll need your own funds, often around 30% to 35% deposit plus any fees. Arrangement fees are usually around 1 to 2%. Then you've got valuation fees, solicitor costs, and then there's potentially broker fees as well. So if I break down a simple example for you, if a client purchases a rundown terraced house in Essex for 250,000, it's going to be unmortgageable because it's got no kitchen or workable bathroom. If they took out a bridging loan at 65% loan to value, so they're borrowing 162,500, they'll fund the remaining £87,500 deposit with around, roughly about £30,000 worth of refurb costs and approximately £10,000 worth of fees from their own cash. 6 months later, this property is going to be fully refurbished and it's now worth £325,000 for argument's sake. So if they refinance this onto a buy-to-let mortgage at 75% loan to value, they'll be releasing £243,750. They'll use that finance from the buy-to-let mortgage to repay the bridging loan, which covers the remaining costs, and then they've added a high-yielding property to their portfolio, plus some equity. So is there a catch? Well, bridging finance isn't based on your income, it's based on the value of the property and your exit strategy. The lender wants to know exactly how you plan to repay the loan at the end of the term. That might be via a straight remortgage, or it could be a sale. So if you don't have a clear, credible exit, you shouldn't be using bridging finance. Also, make sure you work with a broker that actually specialises in bridging finance, such as myself, because it's completely different to the world of standard mortgages. It's about structuring the deal properly from day one to avoid any nasty surprises. If you are thinking about using bridging finance for your next property purchase, whether it's unmortgageable, it's an auction property, or you need a quick turnaround opportunity, I'd love to help you structure that properly. So if you are ready to get started, please just book a call with me today. I create straight talking videos for UK landlords covering buy-to-let, bridging loan and smart property finance strategies. If you're serious about growing your portfolio, YouTube's picked a video out for you here. So give that one a watch next. Thanks for watching, and I'll see you next week.